All right, just as a reminder, the business of managing risk is a risky one. If you have any questions about your operation, please reach out to one of us individually. Risk management is not one size fits all. All right, let's dive into a little bit about what Riskology means. A few things that we're wanting to take away from this series. We're looking at a practical, disciplined approach to managing ag market uncertainty. We're talking about mindsets, tools, and the process in which you can go about managing that risk. We're going to focus on protecting farm profitability across many volatile cycles. Let's talk about some of the goals from this series. Objectively, we're looking to understand major forms of risk across agriculture. We're learning practical tools to manage price, yield, and margin exposure. We're going to build a repeatable decision making framework and then strengthen long term financial stability in those markets. Let's talk about us here just for a moment here. We're going to talk about who we are, kind of what we do, and then how we go about doing it here at Professional Ag Marketing. Here at Professional Ag Marketing, we we go about some things differently. There are just some things that you can't control. One of them is being markets, which financially can make or break a farming operation. But at Professional Ag Marketing, we work hand in hand with producers like a lot of you and identify areas of price risk, set targets, and make good decisions for your business for the long term. And this will keep your business profitable and prosperous from year to year. Plus, we want to put trust into our own valued solutions each and every day. And when I go about that, I like to go about the phrase that we have skin in the game. And by this, I mean a lot of us have come from and are ag producers one way or another, whether it be a row crop operation or raising a feedlot, etc. We like to utilize our practices each and every day in our own operations, managing risk at any scale. So if you have the question of should we work with professional ag marketing, am I too small or too large, I'd like to say we work with producers from each and every size through the spectrum. And then we want to drive confident decisions. Here at Professional Ag Marketing, we believe that the decisions made to protect the farm should involve the person who's there each and every day and has shareholder value. So when it comes to making it a one size fits all and just hiring a marketing firm to do your marketing, we want you to be a part of that decision making process as well because you know best for your business. And then we're going to focus on just what you need. We're not going to flash you out a bunch of cool bundles or packages that we like to sell, kind of one and done. What we like to do is work through a valued approach that is consistent through the long term, that's simple and easy for your business. And then last but not least, in the day and age of technology and AI, I would just like to stress the importance of what a relationship can do for a business, especially in something like farming and agriculture. We all know that your business was based on relationships, as was ours, and we want to continue to value that approach. When we look at the professional ag marketing footprint, we are now across the entire United States nearly and working with companies globally as well. When we look at the team now, our team would consist of over 12 risk managers, many support staff as well, IT who's helping me on this today, for example, and then a market research specialist as well. So we have added quite a few team members over the years, even a couple branch offices throughout Iowa and Minnesota here as well. When it comes to some of our technology updates that we have made, a few things like our website, for example, we've started to really tailor our website for interaction with you to benefit your business, along with a few things like ProAg Power that's very exciting to help create a risk management profile like yourself. And then looking at market data as well, trying to track lots of pesky things like USDA reports or port cutout, things like that, that can be beneficial as data to follow each and every week. And then last but not least, obviously podcasts. We've got 3 a week, and then our Riskology series here as well. But please, if you haven't checked out any of those podcasts, please check out one of those 3 each and every week. We start with hogs, cattle, and grains on Fridays. All right. So let's get into what a commodity is a little bit and what we do here at Professional Ag Marketing. In simple, I would like to say that I help grain and livestock producers manage the price risk of commodities that they buy, sell, and grow. Commodity, let's focus on that here a little bit, but our customer's business is very different from someone in town like an office dentist, for example. Our customers, like yourself potentially, they grow, buy, and sell natural resources that's vast pretty much everywhere across the globe. Every product is equal to one another, and those tools and there are tools available to help us manage that price risk, like trading platforms, and then give us a visual and transparent price to the second on those products that we grow and sell. This is a very unique system. So this commodity business is very different from many other retail businesses that you may be familiar with. But in basic terms, a commodity is an interchangeable good that is the same no matter who produces it. Each product is the same, and that's very important. And a commodity has no brand. There is no brand on it. One unit is equal to one another. So that is very important when continuing to watch at what a commodity is and identifying it. Buyers do not care who made it. They only care about a handful of items, and that'd be one, price, quality specs, and then delivery logistics as well. So some of those examples would include corn, cattle, hogs, crude oil, gold, for example, on some of those. So let's look at maybe what commodities are not. One would be Starbucks, for example. You are cool if you drink Starbucks. At least that's what it was in the early 2000s. When it comes to commodities, the coffee bean may be a commodity that Starbucks buys, but Starbucks as a whole, the product they're selling is a product that gives you an identifying brand. Commodities are not that. Commodities are not a durable good or service. A service like professional ag marketing, for example, what I'm doing here today, providing a service, helping farmers manage their marketing needs. The other thing would be a dentist, for example. One dentist is not equal to another. Kate, I know one thing. I wouldn't want you to fill my cavity, for example, compared to the other dentist in town. So for example, that is one way of looking at what a commodity is not. A restaurant meal. Obviously, if I cooked you a meal, you might not like it, but the five-star Michelin chef down the road, that'd taste a heck of a lot better, I presume. So other branded products like Nike shoes, for example, it's a product, but it's not really a commodity. A John Deere tractor, product, but not really a commodity. So those are some businesses that set their own prices on their products because they have a good brand. Commodities do not. Let's keep on moving here. Let's talk about why this matters a little bit. Prices are discovered on open and very transparent exchanges through the world, the most familiar of which would be something like the Chicago Board of Trade or the CME Group or the London ICE, for example. These exchanges help transparency. It's a way for everyone to go find what a product or what a commodity is worth as a generic understanding. Prices change consistently. If a global event happens, for example, prices change within seconds of that. 9/11, for example, we changed prices on crude oil dramatically over a very short time frame. So the transparency in exchanges is very, very important with price discovery. And then producers obviously face a lot of risks that they can't control, just like the one I talked about there, or weather, for example, would be the perfect risk for an ag commodity. When I was a senior in high school, I had to do a senior project, for example, and I did my project on how weather affects commodities. It happened to be through the summer of 2012, so a little bit of a blessing. That was a massive drought. So that year, no rain in the western corn belt or a lot of through the Midwest, and the price of corn shot up, for example, because supplies were low. So that's a great example of one of the risks that we can't control in these markets. And that's why tools like futures and options, which we'll learn about later in one of these later webinars, but those tools exist to manage risk, especially around crazy events or because of events like that. And a commodity, and in a very basic sense, a commodity is a basic good that's the same price everywhere. It's the same product everywhere with a price set by the global market instead of the individual producer. Let's go on to a little bit about volatility. We talk just a wee bit about some of the volatile, risky business that is talked about here through this podcast. But one would be ag market volatility realities. So commodity markets are more volatile than ever right now, whether it be global weather, geopolitics like the president you have in place, macro forces drive price swings as well. So a few things there to really just grasp around. Producers, they face tighter margins and more financial pressure now. Your capital risk is greater than ever. Land valuations are incredibly high compared to where they were 20 years ago. So the amount of dollars that you have tied up in your investments is greater than ever. So we want to just say that waiting to act generally increases your risk exposure. If I'm producing a commodity and only creating more of a long, the less I sell or the more I wait, generally will continue to create more risk on your operation. So let's define risk because we keep talking about this word risk, but price risk is market moves against your revenue or cost structure. Yield risk, production outcomes are below expectations, so yield out in the field, those drop. And then margin risk would tie everything together, which would be your profits are being squeezed between falling prices and kind of rising costs. So when I view risk management at professional ag marketing, and most of it doesn't have to do whether I plant a seed in the ground and it doesn't grow or it gets hailed out. A lot of the price risk management I do is just based upon the price drops, which would drop your revenue in your operation. Now, professional ag marketing also offers things like crop insurance, which that would be more on that side of things with protecting your crop as well. But a major part of that now is price risk involvement as well, which we'll get into in the next series with Lucas Peters. So risk, obviously a big deal, but with that comes financial exposure. So how do unprotected bushels create real dollar exposure? I mean, it's pretty simple from the standpoint that the producing commodity or the commodity you produce, price drops in value, your financial exposure is still the same as it was before. Just because my product goes down in supply or on my operation doesn't mean the entire globe's supply went down as well with it. So that's very important to realize because just because I had it bad on my farm out my back door doesn't mean a lot of my neighbors or even across the world had a similar or same problem at all. So that's one thing to really go through. Exposure increases as price volatility increases. So, for example, the last few years, inflation has been a steady talking point after COVID. When COVID hit, a lot of dollars were printed. We came out of it. We wanted to do things, and then we saved up the money to do them. So we wanted to drive cars, for example. We wanted to go out and eat expensive steak. And with that demand, became higher increased costs. And now those costs have stayed sticky and they've stayed high. And as the way down of our pricing, our commodities got weaker in price, this price is sold off, the inflationary aspect of our costs stayed high. So it still costs very high to produce an acre of corn, even though our prices have dropped off. So this is something like seasonals or cycles that we could talk about here in this later in this presentation to really go through a little bit as well. But financial exposure is a massive part of why you manage price risk. And to put that into this scenario as well, financial exposure definitely depends on a few things. I could have two similar producers have very different financial exposure. I could have one that owns all of his land, for example, which in essence, he doesn't have much risk. If it's paid off, if corn goes really, really low, he's probably going to go broke last. If I have a producer young like myself that rents a lot of his farmland, or he just bought farmland at a very high dollar amount, very leveraged, you are going to fall in a different risk category than the prior producer. Even if we farm in the same area, similar backgrounds, etc., we could have two very different financial situations. So when I view a risk tolerance level, if I have a customer like myself who's young with a lot of risk, I'm going to be quicker to take risk off the table. We can't stand some of the really bad years. We need to make sure we make money over the next couple of years. So we're going to manage risk, sell aggressively. The next producer can take a few more gambles. He can shoot for a little bit better weather run. He can shoot for a little bit better, stronger seasonality. He can be a little bit more flexible in his decision making. And just because their financial situations may be different doesn't mean that their risk tolerance is either. I have some folks who are very well off that, if we make a profit, we're taking it. And I have other folks who are like, I have an aggressive personality and I'm going to swing for the fences here for a little bit. So it really depends on the producer and what their risk tolerance levels are. So let's talk about a few of the reasons why we manage risk. But the first thing would be protecting cash flow. When I talk about the importance of hedging or making sales based upon profitability and not logistics, this is what I'm talking about. A lot of rent checks are due right around this time of the year, January, February, March. The thing is, I don't want to have to sell grain to pay off that rent check. I don't want to be forced into that decision making. If I know that's coming up, we've got ample years in front of us just to say this price is good enough for that crop I'm going to produce to pay that check. So think ahead, be proactive, and that's one of the ways I like to protect cash flow. I don't want to have to market my grain or commodity in order to create cash flow at a certain time. And if I have to, then I'm going to make sure I've got it sold or protected ahead of that logistical time frame. So if you manage risk, this allows for smooth revenue even through price volatility as well. So even though the price goes up and down, I can kind of keep steady pace through the years and sustain a steady business. And this allows us to have capital, working capital especially. So when I talk about the up years and the down years, it's very cyclical in commodities. Land prices, for example, it seems like you have to really conserve and save money through the really good times to be able to buy the ground or the piece of ground that comes up across the road from your operation that you've always wanted to buy. If it comes up at the wrong time and you don't have much of a plan, you can have extreme stressed out situations trying to buy that at a time you just financially can't. So trying to market and protect for things like that, which I would consider a legacy type of event, is very important. And this just creates better stressful times through cash flows. Let's talk about supporting credit worthiness. So when I work with a lot of producers, everyone works with a banker. They have things like lines of credit, operating notes. We buy land that we put on loans. So it's very nice for us to work with a lender that's going to prefer a structured price management program. And with that plan, a lot of what we do is create a marketing plan that can help smooth you out through the good times and the bad, and that creates a trustworthy component for you and your lender when you work together. So I find that to be very important as well. This reduces the need or volatility around some of the operating note changes, or reduces good years to bad years, and it can really help smooth things out, and that helps maintain a healthy relationship with your credit lines. Let's talk a little bit about avoiding exposure to black swan events. So the thing I mentioned earlier in 2012 was a black swan event, which, to just reiterate what this is, it's a very rare event. It's something you didn't see or even knew could happen, but one day you walk out and you see a black swan sitting there instead of a white one. So it's rare, and it's an extreme market event that can cause extremely hard financial trauma to your operation. Um, we want to protect against black swan events, for example, something like an ASF in the United States, where all of a sudden the product you grow like hogs is worthless. Can't move it logistically, it's just not worth it in your area. Things like that. So risk management doesn't eliminate those shocks, but it helps manage or decrease their impact on your operation. So let's talk a little bit about the tools that we use to manage marketing risk. Now, I'm not going to go into exactly what an option is today or what a futures is today. We'll get into that at a later time frame, but let's just talk about a few of the different options that we use to help manage marketing risk that you'll hear and use terminology going forward. So one of the things would be a cash sale. This is pretty simple. It's immediate pricing. For example, if I have a truck full of corn and I wanted to take it to the elevator today and sell it, that would be an example of a cash sale. That cash sale is derived from two things. It would be the Chicago Board of Trade futures, for example, what corn is worth in Chicago, for example, and then what corn is worth in the United States at my location that I'm taking it to. Those two differences in prices would be equivalent to basis. So when I look at what a cash price is, it's Chicago Board of Trade plus basis equals cash sale. Now we'll get into some of these terminology things and how this math works later on using some better slides, but this is just one of the examples and probably the most common. The other would be a futures. What we do each and every day, and what my revenue is mainly derived from, would be locking in futures for producers. So this would be locking in price levels while maintaining the flexibility to go anywhere they wanted with that corn. So one of the problems is if I make a cash sale for a forward time frame, I'm locked into that elevator. If I lock in futures instead, I can still take it to any elevator I want, which is important because some elevators will pay more than others. So that's something worth noting. Options, we want to use protection on floors, but we want to retain some upside potential. I want to have protection because maybe prices are falling and I'm worried about what time of the year it is. However, I want some upside potential. So that would be more of an option strategy that I use in that instance. And then another thing, which would be insurance tools. Now more than ever, we use insurance tools as a price risk management tool. The government has heavily subsidized these products for you to be able to use things like multi-peril crop insurance, revenue plus corn yield protection, for example, or LRP, which would be livestock risk protection. This would be basically like a put option, but for livestock, it would work just as a price risk management tool. Same on LGM. That would be a margin protection. So a few things to talk about on the insurance side. That'll be our next webinar before crop insurance decisions are made. Just talking about how some of these products work. Let's talk a little bit about margin-based decision making. When I look at focusing on a profit, just not the price, this is important to understand because more than anything, margin is going to trump price, seasonals, emotional aspects of it, and this is a very emotional thing. So we like to take a margin-based margin-based plan basically and go about risk management that way. This helps determine action at the right margin levels as well. It helps make decisions and eliminate some of the guesswork. So let's talk about the process and the discipline that we look at. So I want to look at a repeatable workflow. I don't want to just look at something and say we can hit the high 1 out of 10 years in this market. No, I want to look at this and say I can make money for the next 10 years, or at least give myself the best shot of doing that. So a repeatable workflow, which would be you start with the profit. Does this sale or level make money or make sense for my business? Then you start to filter through some of the other options to decide more intraday type decision making. So let's filter through like a market cycle. Are we in equity preservation years or expansion? What seasonal time frame is it? Seasonally, corn likes to have a high in May or June. Is it a little bit early right now in January to be looking at selling corn from a seasonal aspect? Fundamentals. Is a corn balance sheet really tight in the United States, or is it really burdensome? Then look at money flow as well. A lot of the time, these markets are controlled heavily by the speculators in Chicago, for instance. So when I look at money flow, if they have a record long position, might be time to take some risk off the table. And then obviously technicals and report dates as well. So when a WASDE report is coming up at 11 o'clock, those tend to be very volatile reports. So manage risk around that report, just knowing that things could get crazy at that exact minute, along with technicals. Are you up against a resistance point? Is this the lowest price corn's traded in X amount of days? Things like that are very worth noting when making very intraday specific recommendations. And then each step that you go down that process, it helps narrow a decision on what you should do for your business. It's not just one thing trumps all. If there was, it would be probably profit. Eliminating emotion and reactive marketing is two of the hardest but most necessary things to do in risk management. It's a very emotional business, like I said before. It's one of the most important aspects of your revenue that you produce. So making a decision on when to take price risk off is very important. And then we want to create just a continuous, reliable structure that you can repeat year in and year out that you can control and have for your business that works. So let's talk about profit first a little bit. One, it helps to know your true cost of production. That's kind of step one. What does it cost for you to produce an acre of corn? If it comes out and it's about $900 an acre, I know that with X yield, I need X price. So that's what's the first real step in knowing what profit first mentality looks like. And or maybe just look at what benchmarking looks like. If I know that Iowa State says my cost of production for this state is X amount of dollars, it helps you benchmark across other producers in your area as well. Second is to identify profitable margins as they appear. So this is important. When an opportunity comes, they usually come really hard and really fast in these commodities, especially in very volatile times like these. So knowing when they appear, having alerts hit, having working orders, those are important and imperative to your business success. And then avoid chasing. We're not looking for the perfect price. I think we focus on perfect a little bit too much in this real world. You just have to take action. And as you move forward, continue to price average, continue to take risk off when it makes sense for your business. Don't just look for, well, I think I could get 5 more cents out of this thing. If it makes sense and it's the right time of the year and the bearish fundamentals are all hitting off, maybe not wait for that 5 cents. Maybe you should just pull the trigger. So a few things like that can really help make a decision. And then obviously protect profitable opportunities before they disappear just because they come super, super fast and go even faster. So let's talk about the first main step after profit, which would be what phase of the cycle are you in? This corn chart, for example, goes all the way back to about 1958 for the nearby corn futures. And this is going to be summed up well. You can look at the macro ag cycles. One would be expansion, one would be peak, the next would be contraction in the poorer times, and then one would be recovery when you try to fill your pockets back up again. Each phase carries very different risk and opportunity profiles, but it's important to try to manage your operation around them. Just like I talked before, it was a really tough row crop timing and farming in the 1980s, but it was also a very good opportunity to grow. And with that, if you started at the right time in the worst of times, and gave you a very good chance to succeed later on in a farming operation. This helps determine if you should be more defensive in the time frame or aggressive. If we're at all-time highs in 2012 on the corn market, should we really get more aggressive, or should we take risk off the table and kind of take the bird in hand and protect the next couple coming up? And then obviously this helps prevent any emotional decisions based on short-term price noise that's going on. We get a lot of that nowadays with who our president is and Trump. We have a lot of geopolitical news that really shakes up the headline. Trump, for example, a rumor can shake up the markets and get traded really hard. When we had Biden in, for example, not much he said really moved the markets. And this isn't a left or a right thing. This is just facts that our markets are more volatile day to day than they were a couple of years ago in certain aspects because of that. And that's great to know because volatility equals opportunity, but you got to take it when you can get it. Talking about some seasonals here, the next thing after profit, then cycle on the markets is probably seasonals in our opinion. Most commodities have a very strong seasonal aspect to their patterns and price patterns. For example, on the screen there is December corn chart on an average. If you look, the average high in December corn usually happens about the middle of June. And with that being the case, it makes sense. We plant the crop in April and May, and then it grows, and then we enter a hot, dry time frame in the United States, which is where our crop can be threatened by weather. So a lot of the time we build in a weather premium into those markets. And then after it gets through tassel time frame in about July, then the prices start to back off again once a crop looks essentially made, is one way of looking at it. Because that price uncertainty just isn't quite there anymore. That supply uncertainty isn't quite there anymore. So the price takes a little bit of a dive. So a lot of these commodities do have seasonals. That's worth mentioning. At Professional Ag Marketing, for example, one of my recommendations is usually to look at what corn you have sold by July 4th. And that's a very strong seasonal that we would like a good chunk sold by then normally. So that's something to watch for. This can help identify strength and weakness periods and then making decisions around those as well. And then use this as a helpful timing aspect. If you have a few other things lining up like profit or technicals or bearish fundamentals, if you throw in the seasonal aspect, that can usually trump things pretty quick and just say, hey, by this time of the year, we're on a rally. I should probably just take some risk off the table. So that helps you narrow down a decision-making process. And this helps avoid marketing during really historical weak periods as well. The beginning of August is historically a very weak time frame in the corn market that can help deter some folks away from getting kind of panic sold. And then let's talk about a little bit deeper dive, which would be fundamentals. One of the ways we like to watch fundamentals are the WASI reports that come out each and every month for the United States. But this helps basically set up two things, supply and demand, and the entire structure regarding those two in the United States that impacts your prices. This, we like to look at stocks to use ratio. So just because we may have a lot more corn than we used to in the United States doesn't mean that's a bad thing. We may use more than we were before as well. So with that being the case, it's important to keep all fundamentals on a level playing field with one another. And then this helps us notice any production shifts, not just for us, but for the world. It's a global marketplace impacted by other producers across the globe as well. So keeping up on them in a timely manner is very, very important. And then keeping up on things like weather forecasts. Is it going to be hot and dry in the middle of June, July going forward? That's important to follow as well because the futures and prices certainly do. Talking about things like exports and feed demand and any growing markets as well. You can track things like an export pace or are we crushing more soybeans because of renewable diesel plants coming online? These are very important things to keep up to date on, but to make a solely based decision based on fundamentals is very difficult. So that's why I like to tie things together like profit first, then cycle, then seasonal, then fundamentals backing into it. And then you can kind of tie in another thing, which would be money flow, like I talked about before. If the funds are very long, if they are record long, which would mean record bought, and they're very, very bullish, how much more can they push the needle? How much more can they add on to it? So that's important with recognizing things like fund positioning and looking at some of the macroeconomic flows with rates and currencies. How competitive is the United States to other countries, for example, on exports? And that can help kind of finalize some of these decision-making processes when it comes to risk management. Technicals, everyone's got their own little twist on technicals when it comes to evaluating a chart or a market. I would just say many folks tend to find the thing that works for them, whether it be moving averages or Bollinger Bands. It's got to be whatever you're comfortable with and can track consistently. It's very difficult to manage marketing risk off of things solely like technicals. It's very intraday, it's very quick moves. It's difficult to manage a business on such volatile and reckless strategies, but it can help make a decision. Like if I know I need to buy corn this next week, let's look at some technicals. Are we at some support points? Did we blow through it? Some of those very very specific trade advice type situations going on in that time frame can help be finalized with technicals, for example. And using some of those things like WASD reports, support and resistance lines that are at some key levels, holding up trends, like those are some things that you can kind of all throw together to help take some takeaways with managing marketing risk here for your operation. If I look at some of the key takeaways, building a risk management profile strategy, let's look at just a few here. One, risk management, it's about protecting profitability, not just about predicting markets. I have a lot of people who I work with that one of the first things I always want to talk about is, are we doing one of two things? Are we managing risk or are we trading? If you put a trade on, is your goal to make money on that trade or is your goal to make money for your operation? Because if I sell 5% of my corn at $5 and we go to 7, that's a great problem to have. Now, the next person might look at it a little bit differently. They may be really frustrated they sold 5% of their corn when we went up $2. So remember, consistency, relationships, trust, all these things have to be built so you know the process and understand with one another what your goals are in risk management. And one of the things to help do that is a disciplined workflow. Just helps remove any emotion. It creates consistent results and just keeps a smooth and steady process. And then understand price, yield, margin risk, just knowing all the risks that are out there and how extreme they can be. Managing price risk is incredibly important because it hits every bushel of your operation for your profitability. When you look at things like that, just know that what are some of the key levels? If we drop more than 20% of our yield, are we going to make it to the next year? If price stays below $4 corn for the next 3 years, can we still make it? So knowing some of those things can help gauge what type of risk tolerance you are, more or less. Using tools like futures, options, cash sales, insurance, now more than ever, you have more tools at your disposal than you've ever had before. So recognize that, learn a few new things, and try to find out what works best for your operation and credit needs. And then last but not least, kind of long-term success. This comes from a consistent review. It comes from margin awareness, and it just comes from a structured decision-making process. And I think that's kind of the main take-home with all of this. So a few of the ways professional ag marketing helps producers go about this would be, we try to make this as individualized as we can. There's a lot of you on this webinar and watching throughout the years. I want to just say that we try to tailor risk management to your operation to fit your needs going forward. And we want to help producers apply a repeatable plan that they can do year in and year out and have some consistency and trust with as well. This isn't just hitting the high one time. And then access to any real-time insight, margin analysis, strategy development. Things are changing ever so quickly. So being able to be on the cutting edge of news and being on the cutting edge of execution is important. If you know your numbers, if you know how much percent sold you are, when that WASD report comes, it's easier to make a decision quickly. And then we want to have hands-on guidance. We want to work with you. We want you to work with us, and we want to use your expertise on your operation to make the best decision possible. And then our goal, just protect profitability across all volatile cycles. I want to make you the most amount of money as I can, not be right on a trade. So that's our goal here at Professional Ag Marketing. And we thank you for listening in today. And if you have any questions, we're going to open up for a Q&A right now, Kate and I. Please shoot a shot here. And thank you all for taking over half an hour of your time to join us today.